How can a high-end spirit, something woven into centuries of tradition business culture, suddenly face an existential crisis? We're talking Baijiu, of course.
Yeah, the potent white spirit of China.
And this isn't about, changing tastes or bad batches. This crisis, it's purely down to a bureaucratic rule change. Just bam, May 2025.
It's a real shock. Ancient tradition meets modern market whiplash, basically.
It seems like the ultimate paradox.
It really is. And the speed, the scope, it's pretty unprecedented. Since this strictest alcohol ban dropped, the whole investment world is scrambling.
Trying to figure out the damage.
Exactly. We're already seeing prices for top shelf stuff like Feitai and Moutai, Moutai starting to slide. And the market, well, the reaction across the board has been brutal. Negative.
Okay, let's try and unpack this. We need to give you, the listener, some real clarity here. We're doing a deep dive into what this all means business-wise, investment-wise.
Yeah, the implications are huge.
So our mission today really is twofold. First, is this new ban actually going to destroy an industry that's, let's face it, survived centuries of turmoil?
A very resilient industry historically.
And second, if the answer leans towards yes or even maybe, how do investors need to completely rethink their strategy? The logic we've used for, the last decade?
It might be out the window. To really get the severity, you have to look at the rule itself.
Right.
This wasn't just like a suggestion. It was a formal regulation, May 18th.
And the title says it all, doesn't it?
It does. Regulations on practicing economy and opposing waste in party and government organs. The language is, it's direct. Austerity is the focus. Intense focus.
So what does it actually ban? Like in practical terms of the industry?
It's pretty much a total blackout for official consumption. Alcohol, banned. For all staff in the party, government, public institutions, on working days, duty days. Full stop.
Okay, that's significant.
And maybe the real killer blow for the high-end market. It's basically banned from all official receptions. Banquets, entertaining, gone.
Wow. That cuts off a major artery, doesn't it? For decades, a huge chunk of high-end Baijiu sales, reliable, high-margin sales.
Guaranteed sales, really.
Right. Guaranteed by the state, quasi-state bodies, official gifts, entertaining, those big state-owned enterprise meetings. You just sever that stream overnight.
And the market reacts violently. It was a massive correction. Stocks of listed Baijiu companies fell across the board.
Because investors see that guaranteed demand just evaporate.
Poof, gone. So they flee, understandably.
Let's put some numbers on that fear. If we look at the funds that track the sector.
Yeah, the Baijiu fund LOF is the perfect example here. For anyone listening, an LOF is a listed open-end fund, trades like a stock, holds a basket of assets, in this case, mostly top Baijiu producers.
Okay, so what happened to it?
After that May 18th announcement, it dropped 4.56% in 1 week. 1 week. And looking broader, since the start of 2025, it's down over 12.5%.
Ouch. So a sector that was, a darling for growth investors for ages.
Absolutely. The star performer.
Suddenly becomes one of the worst performing major sectors.
Yeah.
That signals something deep, right? Investors questioning the fundamentals.
It forces the big question. Is this just a blip, a temporary dip? Or is it a permanent structural reevaluation of the whole industry?
And that structural question, it immediately makes you think.
Haven't we seen this movie before? Any seasoned investor in this space is asking that exact question. And, they're right to ask.
Which takes us straight into our first big section, History Repeats. We have to look back at 2012. That precedent, this isn't the first time policy has targeted official drinking.
Not at all. We need to remember the 2012 8-point regulation.
Right. That was also aimed at austerity, wasn't it? Anti-corruption.
Squarely. Launched by the central government, and it specifically hit alcohol on working days, restricted it heavily at official receptions, designed to curb that conspicuous consumption paid for with public money.
I remember that time. It felt like, immense pain for the industry. The impact seemed immediate, catastrophic, because back then, the state sector was an even bigger slice of the high-end pie.
Oh, the impact was heavy, no question. We saw retail prices for the big names like Feitai and Moutai just crash.
Crash how badly?
It dropped below 600 yuan in those years. And that specific number is critical because, it was actually lower than the ex-factory price at the time.
Wait, selling for less than it cost to make?
Exactly. Distributors, retailers, they were trapped. Selling at a loss just to move inventory, manage their cash flow. It genuinely looked like the industry was heading for a cliff.
That is just staggering. When your flagship product sells below cost, that's a crisis of confidence. So the key question for us today is, if the 2012 ban caused that kind of crash, Why didn't the industry just die? How did it survive? And not just survive, but boom.
Because the industry turned out to be, well, much more flexible than people thought. Structurally flexible. The recovery, it was powerful, swift even.
What replaced the government money?
That shrinking government market was rapidly, pretty efficiently actually, replaced by two new booming segments. First, the business market, think private companies, high-end corporate gifts, deal celebrations in the private sector.
Okay, so private enterprise steps in.
And second, the personal consumption market. That includes, rising collector demand plus just wealthy households buying it for themselves.
So that shift, that replacement, it didn't just stop the bleeding, it actually fueled a massive boom.
It absolutely did. From around 2016 through 2021, the industry hit a golden age. They saw synchronous growth, which means production, sales volume, revenue, profits, everything grew together at incredibly high rates.
So the ban forced them to find new customers.
Broader markets, less regulated markets, and the returns. Enormous.
Let's look at the numbers for the big one, home tie, to really see the scale of that rebound. After the 2012 ban hit, things were slow at first, right? 2014, 2015.
Yeah, revenue growth was sluggish, less than 4% a year. They were basically treading water, just trying to figure things out.
And
then the shift really kicked in. Around 2016, the industry recalibrated, the private market took over properly, and Motai maintained high-speed annual revenue growth. We're talking rates between 20% and sometimes even 50%.
50% growth.
In some years, yeah. The cumulative effect is phenomenal. Revenue jumped from about 33.4 billion yuan in 2015 to nearly 89 billion yuan by 2019.
So nearly tripling revenue in just 4 years after crisis.
Exactly. And the profits tracked right along with it. Exploded. Annual profit went from roughly 16.5 billion in 2015 to almost 44 billion yuan in 2019.
Wow.
So for investors, if you had the nerve or maybe the foresight to buy during that initial 2012-2013 panic, the reward was, well, generational wealth territory, the stock price. Around 200 yuan in 2015, soared past 1,180 by 2019, and eventually peaked over 2,600 yuan in 2021.
That's the story everyone remembers, right? Government cracks down, panic selling, prices drop. But the underlying demand, the brand power, lets the sector pivot to private buyers, leading to these incredible returns.
That's the narrative. And it wasn't just Motai. It wasn't an isolated case. Ouyang Ya showed a remarkably similar pattern.
What did their numbers look like?
Between 2015 and 2019, they basically doubled revenue and more than tripled profits. Their stock rose fourfold, hit a peak around 357 yuan in 2021.
And we saw similar stories across the high end, right? Like Wuzhou, Laojiao, Shanxi Fendiao, Yanghe.
Yeah, all those key players benefited. The structural shift towards premiumization, towards private sector adoption, it lifted the whole top tier.
So the conclusion from 2012 seems pretty clear. The ban's real damage lasted maybe 2 years?
About that, yeah. 2 years of pain. And then it acted almost like a catalyst, forced the industry to ditch its reliance on, well, government spending and find stronger private markets. And that led to a massive stock market run.
Okay. So if history shows a 2-year dip followed by a, 6-year boom?
Yeah.
Why should we treat this 2025 ban any differently? Why isn't this just another buying opportunity after a temporary setback? Why the alarm bells this time?
Because the whole context, the economic landscape, the industry structure itself, it's fundamentally different in 2025 compared to 2012. Completely different.
Oh.
We're facing 3 specific structural headwinds now, and they're compounding each other. These headwinds either didn't exist back then, or they weren't nearly severe enough to matter during that recovery. The old playbook, it just doesn't apply this time.
Okay, we absolutely need to break down these 3 headwinds. They seem crucial to understanding the risk now. Let's start with the first one. You called it the production paradox. That sounds contradictory.
It is, and it's maybe the clearest sign that the growth we saw over the last decade was built on, well, an increasingly shaky foundation. The paradox is this. Total Baijiu production across all of China has been shrinking continuously since 2017.
Continuously shrinking since 2017.
Yeah. By 2024, the country's total output was down by 2/3 compared to the peak levels back in 2016. 2/3 less volume.
Hold on. Production volume down by 2/3. That sounds like a massive drop in actual consumption. But you just told us revenue and profit were soaring during that exact same period. How does that even work?
That's the structural vulnerability right there. While the volume produced collapsed, the revenue and profit of the big leading companies exploded. Total sales revenue for the sector grew from about 562 billion yuan in 2019 to nearly 800 billion by 2024. That's a 42% jump.
Okay.
And profit grew even faster, up 79% over those same 5 years.
How does an industry make so much more money producing two-thirds less stuff? What was the mechanism there?
It boiled down to two things, really. Extreme premiumization.
So the average price per bottle shot through the roof, but the actual amount being drunk by people was falling.
Precisely. And that dynamic completely squeezed out the smaller guys. The low-end, high-volume producers, they couldn't raise prices like that. Their margins just vanished. So that production collapse, you see, that's mostly those smaller, non-premium players disappearing.
I see.
So what looks like growth in the revenue charts for this sector, it's really just the top few companies sucking up all the value by pushing prices higher and higher onto a, frankly, shrinking pool of very wealthy buyers or collectors, while the middle and bottom of the industry just dissolved.
Okay, so that makes the whole industry structure incredibly top-heavy.
Yeah.
Dangerously reliant on a small group of affluent consumers just continually accepting higher and higher prices.
Exactly. Which makes the whole thing extremely vulnerable if that demand suddenly drops. Which brings us neatly to headwind number 2, the shrinking consumer base.
Right, the macro picture. And this feels like the biggest difference from 2012.
It is. It's the most worrying difference. Back in 2012, China's economy was still firing on all cylinders, right? That fueled the private consumption boom we talked about today. The consumer market is showing a clear downward trend. You hear it everywhere. Downgrading consumption. And crucially, the actual group of people willing to buy high-end spirits seems to be shrinking.
And we can't ignore the broader economy post-2023 here. That recovery has been, well, uneven is the polite word. Specific sectors are really struggling.
That's the critical link, yes. Think about major industries, real estate, construction, some parts of tech manufacturing. They're dealing with serious overcapacity or big structural changes. And that puts sustained pressure on company profits, on employment, right across the board.
And when company profits are tight,
high-end corporate gifting, fancy entertaining, that's often the first thing to get cut.
and that pressure hits personal wealth too. If income growth stalls for senior managers, the traditional buyers of top-tier Baijiu and job security feels shaky for everyone else.
Personal discretionary spending just contracts. People pull back.
The whole mindset shifts.
Yeah, from optimistic spending to, okay, let's just cover the necessities. Expensive social signaling, which is, let's be honest, a big part of high-end Baijiu's appeal.
Yeah.
That's one of the first things to go. And we saw warning signs of this consumer weakness long before the May 2025 ban even happened.
Really? What signs were there in 2024? Because the headline numbers still looked okay, didn't they?
They did on the surface, but the internal pressure was building. In the spring and summer of 2024, even the very top end, the stuff people collect and hoard, saw price cuts. Motai. Prices dipped.
Why?
Explicitly because of rising social inventory. Too much stock was sitting around in distributors' warehouses, in collectors' hands. The high prices had finally started to outstrip actual immediate demand. There was a glut.
So the market was already kind of saturated, deflating on its own.
Exactly, and the Q1 2025 results confirmed it. Revenue and profit growth rates for the big players slowed way down into the single digits. Painful. The industry was already bracing for a tough year, a managed slowdown.
So the May 2025 ban didn't cause the crisis.
It just dropped a regulatory bomb onto an already vulnerable, already slowing market, which makes the impact much, much worse.
Which leads us to headwind number 3.
Yeah.
The immediate fallout from the new rules, the government market completely collapsing, and the risk of a really nasty price war breaking out.
Yeah, the government affairs market. It's gone. Overnight. It's a historical artifact now. And unlike 2012, you have these other headwinds, the production paradox, the weak consumer. The private market just can't easily absorb all that lost demand this time.
The symbolism alone is powerful.
Absolutely. You mentioned that anecdote about Motai Group itself.
Serving fruit juice.
At their own shareholder meeting, Motai, a major state-owned enterprise, they served fruit juice instead of their own iconic spirit. That's not just politics, that's active compliance. It signals the immediate, permanent end of that entire sales channel, loud and clear.
So if that huge state-backed demand is just gone, wiped off the map, what's left to support the market at these sky-high prices?
The industry is now leaning entirely on 2 remaining pillars, and both are already stressed. First, pure business consumption, private companies, foreign-funded firms, anyone not covered by the public sector rules.
Okay.
And second, personal consumption, completely outside of any institutional context, just people buying it for themselves or private gatherings. The problem is, the strength of both those pillars is being seriously undermined by headwind 2, that shrinking consumer wallet we talked about.
And There's a generational issue here, too, isn't there? Younger consumers,
Yeah.
the post-80s, 90s, citizens generations, they aren't exactly embracing Baijiu like their parents did.
No, they're generally much more cautious about it. It doesn't naturally fit into their social lives the way, say, wine or cocktails or lower proof spirits might. They're often more health conscious, too.
So the core consumer base is shrinking long-term anyway.
It looks that way. It's a structural decline, hard to reverse with just marketing.
Mm.
And when your demand is shrinking and your premium buyers are getting nervous, the inevitable result is what analysts call involutionary competition.
Okay, that's a term we need to unpack. Involutionary competition. What does that mean here?
It's worse than just a standard price war. Involutionary competition is like a self-defeating struggle. Everyone fights harder and harder just to keep their share of a shrinking pie. You spend more resources, more effort, but the total value doesn't increase. It often decreases. Companies end up just cannibalizing each other's margins to survive.
Everyone works harder just to stay in the same place, or maybe even slide back.
Exactly, leading to collective profit erosion. And we're already seeing the evidence of this starting in the retail market.
The prices are falling.
Definitely. Feitan Monai's retail price is dipping below that key 2,000 yuan level. And if these pressures continue, if no new demand source appears, basic math suggests that price will likely keep falling until it gets very close to its ex-factory price, which is around 1,499 yuan.
Wow. That close. That's dangerous for the whole sector, isn't it? If the undisputed leader is selling near its factory cost.
It creates a domino effect downwards. Every brand below Motai has to adjust its price down too, just to stay competitive. The entire price structure for high-end Baijiu gets dragged lower.
Which puts the big companies in a terrible position.
A strategic nightmare. They might actually be forced to lower their own ex-factory prices just to keep their distributors and retailers afloat, give them enough margin to survive.
And the impact on their own financials.
Devastating. Significantly slower revenue growth, slower profit growth, maybe even negative year-over-year profit growth for the high-end guys starting from Q2 this year right through the end of 2025. That's the fundamental difference from 2012 back then. Growth eventually came back strong. Now, it looks like contraction.
This really sounds like the industry is at a crossroads, a forced choice. Either engage in this value-destroying price war, which will kill off the weaker players eventually,
Leading to a real collapse for many.
or find some radical, completely new ways to grow, new paths forward.
That's exactly the dilemma, the domestic market. It's hit maturity and contraction at the same time, and the policy shock just poured fuel on the fire. The focus has to shift away from just maximizing domestic prices towards fundamental changes, global expansion, operational efficiency. It's a moment for, well, creative destruction, really.
Okay, let's dig into that. Section 3, the path to rebirth.
Yeah.
If the old ways are broken, how does this huge, historically inward-looking industry pivot? What are the strategic options, the necessary choices?
I think there are three main strategies they absolutely have to pursue now.
Yeah.
For survival and hopefully rebirth, the first is internal, consolidation and scale.
Meaning more M&A, mergers and acquisitions.
Acceleration is inevitable. In a shrinking market where price becomes the main weapon, size matters, efficiency matters. So expect to see more deals, big companies buying up rivals, or complementary businesses.
Why? To gain market share.
Gain share, yes. Eliminate some domestic competition. And crucially, gain economies of scale, lower their costs. It's a classic defensive move when price wars loom, get bigger to survive the fight.
Okay, so M&A helps internally. But what about engaging the market? How do they keep the high spenders they still have and maybe, just maybe, attract those hesitant younger drinkers?
That requires strategy number 2, innovation and retention. This isn't just one thing, it's several. Product repositioning is urgent.
Like what? Lower alcohol versions.
Possibly. Lower ABV products. Maybe developing sophisticated Baijiu-based cocktails or mixed drinks. Focusing on premium, limited edition collector's items rather than just stuff for drinking at banquets. The marketing has to change too. They need to find ways to keep their traditional base loyal while also genuinely connecting with those post-80s, 90s outsourced generation.
It's not enough to just rely on the prestige and history anymore.
Not at all. They need modern relevance. But the third strategy, this one is absolutely critical. For the long-term health of the entire industry, globally speaking, it's internationalization under pressure.
Ah, yes, the perennial question for Baijiu. Given how huge it is domestically, its global footprint has always seemed surprisingly small.
Small is putting it mildly. The overall internationalization level for China's Baijiu industry, it's less than 5%.
Less than 5%.
Yeah. Think about other major national spirits. Scotch whiskey, tequila, Russian vodka. International markets are vital for them, often more than half their sales, half their growth. For Baijiu, 5% is negligible.
Wow. For a product with that kind of cultural weight, equivalent to maybe cognac or top-shelf whiskey, that signals a massive untapped market out there, if they can figure out how to crack it.
The potential is enormous. You've got a built-in starting point.
Yeah.
Roughly 70 million overseas Chinese. That's a familiar cultural market to target first.
Right.
But beyond that, the huge global spirits consumer base, currently dominated by Western drinks. It's a vast ocean of potential customers waiting for someone to figure out how to introduce Baijiu in the right way.
So if the potential is so huge,
Yeah.
why hasn't this powerful multi-billion-dollar industry already gone global? What's held them back? Why aren't they already like Scotch?
Fundamentally, lack of incentive, because the domestic market was just too easy for too long.
Easy money at home.
Pretty much. When your domestic market is growing fast, you can easily hike prices. And state-linked consumption guarantees stable, high profits. There's just less motivation to tackle the immense complexity of going global.
It is complex, right?
Oh, yeah. Adapting the product to foreign tastes, building global distribution, overcoming cultural barriers, dealing with totally different regulations. It's hard work. It takes serious investment.
So the comfy domestic setup basically allowed for, what? Strategic laziness on the global front.
You could say that. Why bother with a tough foreign market when you can just raise domestic prices 20% and hit your targets? That dynamic. It's broken now. The domestic market isn't easy anymore. It's difficult. It's contracting.
And that's where the pressure from this 2025 ban becomes the real catalyst.
Exactly. Now, these companies are being forced to look outwards, to accelerate their international plans purely for survival. Going global isn't some optional high-risk adventure anymore. It's becoming a strategic necessity to offset the shrinking market at home.
So the companies with the cash, the brand strength,
And the greatest survival pressure. They'll be the ones to finally drive this. It sounds harsh, but this severe regulation might actually be the only thing that could force the industry towards true global maturity.
Okay, this analysis completely changes the investment picture, which brings us to Section 4, rewriting the investment logic. If that historical pattern panic, then boom is broken, what's the rational way to look at Baijiu investments today?
Well, the first hard truth is that this consumption shrinkage, made worse by the regulatory shock, is going to hurt revenue and profit across almost all companies. For the foreseeable future, we just have to accept that and reevaluate the whole sector's value downwards.
It might be helpful to draw a parallel here. Other major industries that face sudden, permanent shifts.
That's the most rational comparison, I think. Look at what happened in real estate after major financing reforms, or those sharp downturns in industries like photovoltaics or parts of the pharma sector when government policies changed abruptly. When a sector loses its core structural support or faces a permanent drop in demand, the overall investment value just declines, and poor performance tends to cascade down from the leaders to everyone else.
So what's the long view for the Baijiu sector as a whole?
For the foreseeable future, based purely on growth potential, the industry probably lacks sufficient overall investment value. The rational move for investors, both big institutions and individuals, is likely to reduce holdings or maybe just avoid the sector altogether for a while, at least until a clear path to sustainable growth, not just based on price hikes, emerges.
So maximum rationality, risk avoidance.
That should be the guide right now, yes.
And that structural reality makes things like index funds or thematic funds tracking the whole sector particularly tricky, doesn't it? Because they hold everything, including all those mid to low-end producers getting squeezed out.
Yeah, they're inherently high risk in this environment. Those Baijiu index funds or thematic funds, they're likely to see more declines than gains because they're weighed down by the struggling majority. There's very little cushion there against this industry-wide structural downturn.
And we have that painful track record already. The Baijiu Fund, LOF, that benchmark we keep mentioning, it's already been falling for 4 straight years, right? Since 2021, down about 60%.
That's right. 60% drop already. And if performance keeps trending downwards, which we think it will from Q2 2025 onwards, the net value of those funds will almost certainly fall further, that 60% loss. Unfortunately, it might just be the midpoint of a much longer correction as the market finally digests the fact that the growth of the last few years wasn't entirely real.
Okay, let's zoom in on the giants then. The big, established leaders like Motai, Ouyang. Did they escape this? Or are they still vulnerable too?
Oh, they're vulnerable, definitely. because they rely so heavily on that high-margin market that's now shrinking fast. Now, will some long-term diversified investors keep holding them? Sure, because they're huge, cash-generating machines.
But the consensus.
The consensus action is structural reduction, cutting positions. Their growth is going to face immediate pressure because that government market is just gone.
So why would anyone keep holding them at all if the growth story is so challenged?
Two main reasons, I think. First, just diversification. They're still giants in a massive economy. They can weather storms better than smaller players. Second, and this is key for value investors, the cash dividends.
Ah, the payouts.
Exactly. These companies generate substantial, reliable cash flow. Even if growth stalls or even goes negative for a while, that guaranteed dividend provides a kind of valuation floor. It offers some downside protection.
But the real excitement, the potential for big future returns, that has to lie with the companies that actually succeed in those rebirth strategies we talked about, the ones that nail the M&A and especially the internationalization.
That's the only place to look for high growth now, I believe. Investment needs to target the companies driving those innovations. We're looking for the new leaders. The ones who emerge from this period leaner, meaner, more global, more efficient, because they will be structurally healthier than the old guard.
And these new leaders, they might not be the current top dogs.
Not necessarily. Could be. Could be Motai or Wuyuangye if they successfully transform and conquer global markets. Or, and this is really interesting, it could be a medium-sized company, maybe one we don't talk about as much now, that successfully merges, achieves scale quickly, and then makes a really aggressive, successful push overseas.
So the whole investment thesis is flipped. It's gone from buy into the guaranteed domestic boom fueled by price hikes to try and pick the winner of a brutal survival contest where the prize is global expansion.
That's a good way to put it. The old landscape has been wiped clean by regulation and structural decline. The opportunity now. It's in finding the company that masters that incredibly difficult transition, the one that achieves a genuine breakthrough into global markets, something that, frankly, domestic comfort stopped them from doing before.
Okay. Let's try and boil this down one last time for everyone listening. This has been a huge shift. What's the single most important strategic takeaway you need to remember right now?
The absolute key takeaway. This 2025 ban is not 2012 Redux. You cannot rely on that historical rebound story. Those three structural headwinds, production shrinking while relying on price, the consumer base weakening, the brutal price competition they mean this crackdown is hitting at the worst possible moment. You need maximum rationality. Understand this is structural, not just cyclical. Avoid those trending risks.
Okay. And here's a final provocative thought for you to chew on after this deep dive. If this intense pressure, this shrinking, regulated home market, if that's the only thing that could finally force this massive, centuries-old industry to seriously chase global markets, does that mean severe regulation sometimes acts as the most powerful catalyst for true global expansion? Could the collapse of one market actually be the poundful push needed for future global dominance? Something to think about.